expect a big uptick in natural resources, both the stocks and then the actual resources themselves, so various types of commodities, oil, gold, copper, silver, Bitcoin as well. And then hard infrastructure, things like pipelines and assets like that. High quality real estate that's not particularly overvalued. There's different parts of the market where, you can get a nice quality asset with a low, if you get kind of a fixed rate mortgage on it, it's funny, mortgage rates went up a ton, but they're still below the official inflation rate.
Right.
And so I think depending on where you are, that's basically, it's a long-term dollar short, which I think would do well in that environment. And so yeah, basically the outcome of them having to capitulate on tightening should be a big uptick in hard assets, specifically assets that are not facing a lot of margin pressure, which basically means commodities, commodity producers, hard monies, and things like that. I think generally they're more backwards looking than forward looking, which is not good. And to her credit, it's good to admit that she was wrong, and it's also it's hard to say ahead of time what the exact level of inflation is going to be, right? I mean, there's all sorts of variables that could have delayed it, that could have dampened it a little bit, basically, economies opening and things like that. But yes, a lot of us were looking at this inflation picture and saying that it's, we're not seeing the commodity capex. We're seeing a lot of new broad money in circulation, which was different than what we saw in 2008. Basically, just more money chasing fewer goods. And so, they called the whole inflation transitory thing. They were wrong on that. And I think it shows that we just don't really have the most data-driven people running things. And I think that, we zoom out really far. I think the biggest problem is that controlling the price of money is not a good thing to be doing, but it's just an inherent part of our current system design. But I think that's kind of an inevitable problem that you're going to have, just like, in most industries, price controls are not a good thing. And the problem is that there are a handful of things that if you control the price of them, it can distort everything else. And those would be things like energy and money, right? So those are kind of the master inputs that affect every other price. And so because by controlling the price of money or by controlling the price of energy, that can have a billion ripple effects down the road. And I think that's just the problem we face ourselves in the way that we've structured the system over the past century or so. So I think in the long arc of time, yes, I think that not having a central price setter for money is ideal, and that the price of money can be set in different regions by market forces. That's a system that used to be, and I think that in the future might have that again one day. I think a big challenge is that, starting in the second half of the 1800s, commerce started moving faster than money, right? So for thousands of years, commerce and money moved at roughly the same rate, which was, the speed of traveling around. But with the introduction of telecommunications channels, banks could settle ledgers across the world pretty quickly. And then of course, when you add the internet, it accelerates even more. Whereas the money, gold, still had, it still moves at the speed of physics, of matter. And so when commerce began moving much faster than the underlying bare asset, we had to abstract it in order to have it keep up, right? So we had to do claims based on that money rather than the money itself in order to keep up with the speed of commerce. And the problem there is that when you abstract it like that, when the speed of commerce greatly exceeds the speed of money, that allows for arbitrage and centralization. And so I think that that's been really the story of the past, call it 150 years of monetary history, is that policymakers have been able to arbitrage that difference and make use of the fact that we have a separation between the claims to the money and the underlying money itself. And so I think in some ways it was inevitable to happen. I mean, when we see something happen where, there's 200 countries, which country doesn't have a central bank? Which country has free banking currently? Which country is on a gold standard? It's kind of like once it became possible to do, it happens everywhere, or at least no major one that I can think of. Maybe around the margins, there's some little tiny one, but yeah, basically, when you have that large of a sample size and you see it does not happen, there's some degree of inevitability to it, which is unfortunate. And so I think that after this particular system works itself out, we'll see what happens with the next system. Maybe we can go back to a different type of model that is more decentralized. But I think so. My answer is kind of that one, I don't think it's a good system, but two, just because of the order of technology we got, I think it ended up being somewhat inevitable. I think the challenge is that because we've constructed the system this way, it becomes like a shark that can't stop swimming, otherwise it drowns. Basically, the debt, a credit-based system has to keep growing, otherwise it collapses. There's kind of no in between. So, let's say you go back theoretically to the 1800s, you have, gold as base money, you have claims on that. Claims maybe a few multiples of the base money, but it's not massive, right? And so when you have a recession, some of the malinvestment gets cleared out and you kind of restart from there. Whereas going back to like 2008, there were something like 60 claims on base money, meaning that, for example, the total debt in the system, just from memory, was something like 60 times higher than the amount of base money in the system. And we saw the same thing kind of happen back in the 1920s, where you had this huge gap between all the debt in the system and then the base money, and then ended up increasing the base money. And so I think the way the system's structured, it's hard to do it in a disciplined manner. It's again, it's kind of like asking, why are there no countries with no central banks? And it's kind of like saying this system is it's designed to always grow. And I think that until we kind of structure the system differently, it's hard to do it in a sustainable way. And that sounds, doomy, right? But I think if you go back in history, I mean, these sort of systems don't last this long. This particular fiat system from the 70s has been the longest lasting and most sophisticated, grandest version of it. But I think people should be careful about having recency bias. They think that the systems function this way for 50 years. Why can't it go for another 50 years or 150 years? But the history of the world is kind of the history of changing financial systems, changing money, kind of changing things like that. And so I think that as we look out longer term, I do think that this system's unsustainable, and that the way our money works, decades from now will probably look quite different than how it looks now. I think that's the most credible way to maybe introduce something new, right? But it's still early technology. I mean, Bitcoin's 13 years old. It's being tested to see how it's going to handle that. I think basically digital bearer assets, particularly if one can capture the majority of the liquidity and network effect, introduce a new way of doing things. But that's kind of the expectation, or the hope of the expectation of what's possible. But there are still ways that can be messed up, or that can be disrupted in some way. So it's something I'm watching, and I think it's worth looking at it, building on it, exploring it. But I think until we have a structural change, I think we're in an environment where they're kind of forced monetizing. And ECB is in a particularly rough spot because their countries, their sovereign bond markets can't really work without ECB support.